So you just bought a home, or you sold one. Let's talk about what that does to your taxes in plain English. If you bought, then the big question is, will I itemize? You only deduct mortgage interest and property taxes if you itemize on Schedule A. The standard deduction is high, so many people still don't itemize. Here's the math I do. Add up mortgage interest. Add up state and local taxes, capped at $40,000 total. Add up charitable gifts. If that stack is bigger than your standard deduction, itemizing may save you money. For loans made after December 15, 2017, you can generally deduct mortgage interest on up to $750,000 of acquisition debt. Acquisition debt means money used to buy, build, or substantially improve your home. Older grandfathered loans may have a $1 million limit. Home equity loan or HELOC interest? It's only deductible if you used it to improve the home, not for vacations or debt consolidation. Keep receipts. Points you paid at closing, sometimes called loan discount points, may be deductible in the year you bought, or else deductible over the life of the loan. Your Form 1098 will help, but the settlement statement is gold. Property taxes are deductible if you itemize, but they count toward that $40,000 SALT cap. State income taxes or sales taxes also hit that cap. Hit the cap? The extra doesn't help your federal return. Energy upgrades can be powerful. The Energy Efficient Home Improvement Credit may apply for insulation. It may apply for heat pumps, new windows, and solar. Save invoices and manufacturer certificates, and look at Form 5695. Home office? If you're self-employed and use a space regularly and exclusively for business, you might deduct it. W-2 employees generally can't. Now, if you sold, this is where the home sale exclusion can save the day. If it was your primary residence, and you owned and lived in it for at least 2 of the last 5 years before the sale, you may exclude up to $250,000 of gain if single, or exclude up to $500,000 if married filing jointly. You can usually use this every 2 years. Your gain is the sale price minus your adjusted basis. Basis starts with what you paid, then add closing costs that are part of the purchase, plus capital improvements. Think of a new roof, room addition, and major systems. Repairs don't count. Selling costs reduce your gain, such as agent commissions, transfer taxes, and title fees. Keep all documents. Did you ever rent the home or claim depreciation for a home office? You'll likely have depreciation recapture, taxed up to 25%, even if your gain is otherwise excluded. If you don't meet the 2 out of 5 rule, a partial exclusion might apply for certain job changes, health reasons, and other unforeseen circumstances. Expect a 1099-S from the closing agent. If your gain is fully excluded, you may not need to report it, but many people do anyway to match IRS records. If you have a taxable gain, use Form 8949 and Schedule D. State rules vary. Some states tax more, some less. So check your state's guidance. Quick pro tips. Don't prepay extra property tax just to chase a deduction if you're already at the SALT cap. If a large taxable gain is coming, consider making estimated tax payments to avoid penalties. Organize a house file with your closing disclosures, 1098s, receipts for improvements, and energy credit docs. Your future self will thank you. Buying or selling a home can be great for your life and your taxes if you know the rules. If you're unsure, spend an hour with a CPA. It often pays for itself. Thanks for watching.